price or the exercise price is a fixed price which you can buy or sell the related shares if you choose to exercise your right before the option expires. This price cannot be changed. It's fixed. Okay, it's fixed by the market. Okay, so we don't have control over it. It's like, for example, I'm renting my room for £100 and I have a tenant. Okay, £100 is fixed for a week. There's nothing I can do about it. So that fee is fixed. Okay, and we have the premium. The premium, I call them the rental fee. Okay, similar to renting property, we make the rental fee called the premium. So somebody actually pays us that rental fee to get hold of our share, and then they do whatever they like with their share. And the expiry date, like I said, expires on the 3rd Friday of every month. Okay. Here's a quick example of an option quote. The ABC will be the name of the company. November 16, 2012 is the date of the contract, and the 40 is the $40, how much the share or the option contract is being traded for, and a put is a type of the option. We have two types of options, a put and a call, and $2.70 is your rental fee, how much you have been paid from somebody renting your shares. Okay. And like I said, there are so many strategies in the options market. We have naked puts, so many strategies. But the strategy I'm focused on is called covered call option. Okay, simplest name to remember this is share renting. Similar to renting a property. There's nothing to it. You have a property. A tenant comes and lives in the property. They do what? They pay you rent. The same way. So if you understand the concept of share renting property, you understand the concept of covered call option. Okay, and it's a strategy that the rich have been using. They've kept it secret from majority of us, and they don't actually share it with people unless they really like you. And I had a millionaire mentor who actually introduced me to options. So they've been using this strategy since 1973, like I said, and it's only 2%. And like, I mean, today you are part of the 2% of the population who actually know about this. Okay. And Warren Buffett, we all know Warren Buffett is a global wealth investor in America, a billionaire investor. Okay, very, very wealthy guy. And he actually used one of these strategies to generate $7.5 million. Okay. In 30 days out of thin air. Okay, so if Warren Buffett is using a strategy, I think I would also like to learn how to use it. Okay, and Robert Kiyosaki read that report that he also uses this strategy to make regular monthly income. Okay, risk-free. Okay, so if all these guys are using the strategy, I think I also need to investigate and use it as well. And they use it to steadily grow their income from 30% to 60% every single year. Okay, I would rather make 10%, 20%, 30% on my money every year than to have it in a bank paying me 2%. Who wouldn't? Yes, I wouldn't put my money in the bank. The bank, they will loan it to somebody else. They make about 100% return. They give me 2% a year. It's not fair. I'd rather put in a strategy where Robert Kiyosaki, Warren Buffett, they have their money, they are growing their income 30 to 60% a year. It's fair. And guess what? Over time, if you compound that money, it will blow your mind. I'll show you a few details. And there are a lot of gamblers in the stock market. You see, the stock markets, day traders, they are trend followers, day traders, people who day trade. They are looking at their charts. Every time it goes up, they make a quick back. Okay, that's not what we do. We don't follow the trend. We just make an educated research about the company we like to go in. And if it favors, then obviously we go in and do our trade. And the rich, you see, they are not among them. They will feed the day traders all these gambling in the stock market with all these things. So they will be happily trade all these strategies. They lose their money and every day calmly collect it. Of course, they calmly collect it, okay? And by feeding the bad habits of the gamblers in the market, they've been able to gain 30 to 60% a year. And in fact, writing covered call, the technical name of the share renting, It's like being a house at like Las Vegas. You go to Las Vegas, big casinos, they have slot machines. Okay, you put money in. How many times do you think you will win? The odds are stacked against you because then they have that mechanism. What you call mechanism within that slot machine to always come out to wipe your money and do whatever they like, unless you're lucky. The same way with the stock market. The rich, they feed the gamblers, they trade, and then they make their money. Okay, so that's where we want to be. And when you write a covered call, you are selling a speculator or a day trader to buy a stock. Okay, day traders they are called the call buyers. They are hoping to make a large fortune on the stock advances for the price of the stock going up. Okay, and their strategy is very, very risky. It's similar to I wouldn't see any business that makes you money. I wouldn't say it's not good or for example, Forex. Okay, Forex. I've tried Forex before, but my patience is not good for Forex. Okay, it goes up and down. I wasn't prepared. I lost money, so I had to quit. I tested it to see how it was. And similar to this, the day traders, they buy the shares. They want to make money from the shares going up within a day, but we don't do that. Okay, we create the contracts, and every single month we have been paid up front. Guaranteed income. Okay. Okay. So while they are losing their money, we are always making money from our contracts. And in short, we are paid upfront guaranteed income for writing covered call, for renting our shares out to the market. And as the seller, we are the seller of the shares of the call option, okay, to the market. Okay. We usually don't care if the buyer exercise the option to buy the stock from us. Okay, imagine I buy the share for, let's say, $10. Okay, I'll create a rental contract on that share at $11, and someone will pay me a fee to get hold of my share. Let's say $1.20. Okay, they will use my share, do whatever they like during that month. At the end of the month, if the share is below the $11 contract I created, I will take my share off that guy and repeat it again. If the share is above the $11, I'll just sell it to him and make 2 lots of cash flow. Okay, rental fee and a dividend. Okay, I'll go into details in a bit. Okay, benefits of writing covered call. The first one is generates income immediately into your account. As soon as you rent the shares you already own. Okay, you actually have to own the shares before you create the rental contract. You have to own the property, or you have to have rights of the property before you can rent out the property. Similar, the same thing. Okay. Second benefit is increases your probability of profit, often substantially. You are not praying that the shares goes up in price to make money. Okay, you are not praying that it goes up before you make money, and allows you to make a profit sometimes 50 to 100% a year without worrying whether the stock is up, down, or sideways. And okay, let me quickly. I'm going to show you how I did it and the return I made. Okay. And I need to point this out. It's not a get-rich-quick strategy. It's something we follow a consistent strategy over time. Okay, and the money you make, you actually compound the money to make it grow. I'm going to walk you through a quick example of how I did it. I bought 700 shares in the company. It was a blue chip company, and it was selling for $13.49, and it cost me $9,443. Okay, to buy the 700 shares from the company. And what I did is I created a rental contract on those 700 shares, and for that, somebody agreed to pay me a premium. So I bought the share at $13.49, created a contract at $15. Somebody paid me a premium, a rental fee of $1.92. Okay, so if you multiply 700 times $1.92, how much is that? $1,344. Okay, instantly, similar to renting out a property. Okay, and okay, if it meant I sold an agreement to him saying that if the price of the share goes up to $15, then he will buy the share off me, and then I'll make a dividend, isn't it? Because I bought it for $13.49. I sold it for $15. How much dividend have I made? $1.51. $15 minus $13.49. plus my initial rental income I received up front. Yeah? Okay, so in total, I made the $1,333 rental income plus the $1,057, which is the capital gain, $1.51 times 700. Okay, but because the shares of company ABC stayed below $15, I took back my share of that guy, and I did the same thing. But remember, I kept this money. Rental is rent. Whatever happens, the shares is mine again, and then I did the same again the following month. Okay, and that was a 14% return on my money. It's very, very, very powerful. Okay. Okay, so you make money either way. If the stock goes up, you make money. It goes nowhere, you make money. It goes down, you also make money. So what happens if the share drops in price? Like I said, you buy insurance for your shares to protect yourself, okay? And you wouldn't buy a house or a car without insurance. So why should a share be different? People don't know they can insure their shares against risk. This might be the first time you're hearing about it. It's real. You can insure your share against a fall in the value of the price. And okay, buying insurance limits your risk and it allows you to continue to generate income in tankless of the months, and you actually don't use your own money. You use the money from your rental fee to offset the insurance. So you are actually not using your own money, and it's 100% tax deductible. And wouldn't it be awesome to have your risk limited like this? Of course, it would. Let's recap. You buy shares at a discounted price. You rent your shares for the month and receive an upfront income. And you then buy insurance to protect yourself. How simple is that?
Sorry, very quickly. How do you decide what shares you're going to buy?
Excellent, that's a good question. I'll go to that in a minute. Okay, so how do you decide what shares? So what I do is I do fundamental analysis and a technical analysis of a company. Okay, and a fundamental analysis is I look at the balance sheet of the company, making sure the company is profitable. So I don't just buy shares from any poisonous company that I look at the figures. For example, I'll look at the market capitalization in the billions, anywhere from 1 billion and upwards. I also look at their income. Are they making money? Okay, before I buy the shares. I also look at the price to earning, the price earning growth. How's the company growing over the years? And I also look at the debt to equity. Do they have debt? Okay, so if, for example, the company goes bust to tomorrow or today, can they offset? Do they have the liquid money to pay off all their debt? I also look at that. And most important, I also look at the return on equity. The return they will pay me on my investment. Okay, so all these things is the fundamental analysis. It takes me less than a minute to go through it, but you need somebody to mentor you to go look at the figures correctly. And I also use, if you want to look at the fundamental analysis, you go to www.wall street, street is ST watchdog, wallstreetwatchdog.com. It will give you type in a particular company, their stock symbol, it will give you that chart, Wall Street Watchdog. And I also use technical analysis to make sure the shares are going up. Okay, even if the shares are going down, I can still make money. If it's still staying at the same level, I can still make money. But preferably, we would like to look for shares that are going up. Okay, and it takes less than a minute. So this is an example of a share going up in price. And for the technical analysis, you go to stockchartswithanas.com, www.stockchartswithanas.com. Okay, and the strategy I teach most of my coaching students is compounding. Okay, you make the money, you don't eat your. They say if you have a cow, you don't kill the cow. You have to milk that cow for God knows. So this is a compounding strategy. The money you are making, don't use it to go and buy fancy stuff. Compound over time, and over time it becomes very, very huge. And Albert Einstein said, compound is mankind's greatest invention because it allows for the reliable, systematic accumulation of wealth. We are using it to build wealth, not to get rich. You see, footballers are rich. They're driving all these fancy cars, they live in big houses, but they're not wealthy. I want to be wealthy like Donald Trump, Robert Kiyosaki, Warren Buffett. They are, you see, whatever they do, they are making. My footballers, one Manchester guy, he was making about £5,000 a week, and now he works in the post office. It's very sad. Okay, so he was rich, but he wasn't wealthy. And the key to building wealth is, with options trading, is a consistent generation of income in a highly conservative manner. And I'm going to show you, there's 10 years of simple, repeatable, consistent compounding your money. Assuming, let's say every month you're making 5% of money, which is very, very achievable. Sometimes I make between 3 to 5% of my money, sometimes as high as 10%. It depends on the shares I buy from the company, okay? So, let's say you start with £3,200, which is about $5,000. Making 5% a month, in 5 years, he has gone up to almost £60,000. Who would like that? Starting with just 3,200. Starting with £6,300. In 5 years, £117,000. A lot of money. People don't know the power of compounding. Okay? The same £3,200 in 10 years, over £1 million. 5% every single month. 10 years. At least you can spend 10 years of your life with £3,200 to build something that you can retire on. Okay, £6,300, over £2 million in 10 years. Very powerful. That's where I want you to be. At least have the mindset that in 10 years, it's possible to start with a little amount of money and grow it substantially over time. Okay. Okay. I think I've delivered priceless information. Yeah?
Yes.
So, when you leave this seminar, you